Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. So if you, like a lot of folks, maybe just check your phone right around the close, 4:00 p.m. Eastern, you might be a bit confused today. Because looking at those final numbers, the major indices, well, they suggested a pretty quiet day. Marginally positive, even.
Right.
The S&P 500 closed up, 0.13%, around 6,728, and the Dow up 0.16%, this tiny bit of green at the close. It feels like a total mess, doesn't it?
Oh, it's definitely more than a mask. It's almost deceptive, really. Today was just
That's intense.
some gut-wrenching volatility, completely hidden by that, fractional recovery right at the end.
Yeah.
We saw the Nasdaq Composite, which, let's face it, has been the real pressure point all week at plunged, down over 2% intraday.
2.1%, yeah.
As much as 2.1% before staging this huge late session U-turn just to get back near flat.
That kind of swing, especially packed into the last couple of hours, that's massive. What on earth pulled an index like that back from those kinds of lows? Was there some big news catalyst?
Well, it looks like it was mostly a mix, some short covering, definitely, but also these fresh, maybe highly speculative hopes that lawmakers in the U.S. are finally getting close to a deal.
On the shutdown.
Yeah, to end this government shutdown.
Yeah.
Which is now, the 37th day, longest ever. But, and this is the key thing, the market's internal health, it's telling a totally different story than those headline index numbers.
Okay, we absolutely need to unpack that internal story, because the phrase analysts are throwing around is catastrophic breadth. How can the S&P be basically flat, but the internals are apparently falling apart?
Because those gains are just so concentrated, dangerously so. If you look at the NYSE today, decliners swamped advancers, almost 2 to 1.
Wow.
The specific ratio was 1.97 to 1. Now look, one day of bad breath, you can maybe brush it off, but this just continues this pattern of really extreme distribution, selling under the surface that we've seen all week.
And what's the historical context for that, for this kind of narrowness just persisting?
The comparison is pretty alarming, honestly. And this is where the market structure starts to feel genuinely fragile. If you compare the equal weight S&P 500, where every stock gets the same influence.
Right, versus the normal cap-weighted one.
Exactly, versus the market cap-weighted index. That divergence is just extreme right now. Some analysis shows that the breadth in the equal weight S&P is now sitting at its lowest point going all the way back to 2003.
2003?
Yeah, think about that. So you have a handful of mega cap companies basically dragging the whole index higher or keeping it afloat, while the vast majority of stocks are just seeing relentless selling pressure. It's a structure really built on, narrow leadership and, frankly, fear.
That kind of extreme concentration, it makes a lot of sense when you think about the biggest fundamental issue hanging over everything. This government shutdown, it's created this severe data vacuum, hasn't it? Markets are flying blind.
We really are. We've hit this unprecedented spot where that critical economic data is just gone, unavailable. The Fed actually had to make its October rate decision without the monthly jobs numbers. First time ever.
Right.
And then today, Friday, the really crucial November employment report, also suspended, gone.
And I know investors, the Fed, they were really banking on that data point to see how the labor market's holding up. What was the consensus expecting that we missed out on?
Yeah, the economists were mostly lined up expecting confirmation of, significant weakening, a decline of around 60,000 jobs, something like that, which probably would have pushed the unemployment rate up towards 4.5%. Now, normally, getting that kind of confirmed weakness lets the market and the Fed price risk a bit more accurately. Instead, we're stuck with anecdotes and proxy data.
So if the main gauges, jobs data, CPI data, are just dark, what are investors in the Fed looking at? What instruments do they have left as they head towards that December 10th meeting?
Well, they're leaning really heavily on things like private sector surveys, sentiment indicators, and honestly, the data we do have is practically screaming caution.
Like the Michigan number today.
Exactly. We got the University of Michigan Consumer Sentiment Index today. It plunged down to 50.3. And just to give that 50.3 number some context, it was way below the 53.0 expected. It represents borderline recessionary readings. I think it's sitting near its all-time historical lows. This is the gut reading of the American consumer, right? And right now, the gut is terrified.
That puts the Federal Reserve in just an almost impossible position. They always say they're data dependent, but the key data is missing. The market, though, seems like it's already decided what the Fed should do.
And that's the core of the dilemma, isn't it?
Yeah.
Market positioning right now shows a huge probability, like 92% priced in for a December rate cut. So investors are betting heavily the Fed has to act.
To counter the shutdown drag and that awful sentiment number.
Right. But, 92% certainty, especially without the jobs report to back it up. It kind of feels like the market is daring the Fed to move, and Chair Powell did recently caution that a cut isn't a foregone conclusion.
Exactly. It feels like the market's trying to force their hand, just based on the fear captured in that consumer sentiment number.
It does. If the Fed just looked at that 50.3 number in isolation, they might feel like they have to cut.
Yeah.
But without the jobs or the inflation data to confirm it, they risk a policy mistake, moving purely on fear instead of the full picture.
And all that uncertainty, the data vacuum, the fragile structure you mentioned earlier, it really showed up today in how investors behaved. We saw this dramatic shift in sector rotation completely flip the script from last month.
Yeah, the panic just translated directly into a risk-off move. We saw sharp rotation away from that quality cyclicals theme that was working and right into defensives.
So what got hit hardest?
The worst performers today were consumer discretionary, down 2.3%. and technology, down 2.0%. And on the flip side, you saw resilience, relative strength in the defensive areas. Energy actually gained 1.0%. Healthcare held up okay, too.
Okay, let's focus on tech for a second, because that seems like where that catastrophic breadth and the risk-off move really collide. We're seeing what some are calling the AI valuation reckoning.
This is so critical because it loops right back to that narrow leadership problem we started with. The biggest names, the highest multiple stocks, they are correcting aggressively.
Like NVIDIA.
Yeah, we saw significant weakness across key chip names. Take NVIDIA, it's now down roughly 13% just from its high back on October 29th, which was around $205. It really suggests investors are structurally rejecting those valuations tied to the AI story, at least for now.
And what's really interesting is that this pain isn't just hitting companies with bad news, right? Palantir, for instance, dropped over 8% today, even though they reported strong results. What's the market saying when even good earnings aren't good enough?
It signals a real philosophical shift, or maybe just a very aggressive repricing of risk tolerance. Investors seem to be revolting against companies with these huge capital spending needs, but without really clear near-term ways to make money from it.
Okay.
They seem worried about firms pouring billions into AI infrastructure today without a guaranteed revenue stream tomorrow. It feels like a flight away from future promises and back towards, tangible, sustainable profits right now.
And this selling pressure, it kind of gets validated, in a way, by some pretty stark warnings coming from the very top of the financial world.
Absolutely. The market's definitely listening to senior leaders. You've got Jamie Dimon out there predicting a significant stock market correction sometime in the next 6 months to 2 years. David Solomon suggesting a 10 to 20% drawdown is likely.
Right.
So when you layer that kind of high-level institutional caution on top of investor anxiety about capital spending, it just creates a really nervous backdrop for those high multiple stretched valuations.
And that nervousness, it didn't just stay within stocks, it spilled over. We saw some pretty powerful cross-asset moves, some divergences. Let's start with safe havens. Gold really stood out today.
Gold had a very strong session, yeah. It surged 1.24%, managed to close back above that psychological $4,000 level, finished around $4,026. And this rally got a big boost from DXY weakness. The dollar index fell about 0.31%.
So what does that recovery in gold tell us? Is there solid support building there?
It really suggests that consolidation support is building pretty firmly in that $4,000 to $4,100 zone. Gold seems to be benefiting from sort of twin supports. You've got ongoing structural buying from central banks globally, plus these elevated geopolitical risks that just haven't gone away. And the resilience is important, especially when you remember it's bouncing back strongly after that historic 5.79% single-day plunge it took back in October.
Okay, so gold is rallying, classic risk aversion. But what about bonds? Were treasuries also screaming recession risk along with that consumer sentiment number?
The treasury market was actually pretty quiet today, which is interesting in itself. The 10-year yield settled just modestly lower, around 4.077%.
Yeah.
But if you want the real warning sign about underlying economic stress, you have to look at the credit markets.
Okay, how are credit markets flashing red?
We look at investment-grade credit spreads. That's basically the extra yield investors demand to hold corporate bonds instead of risk-free treasuries. We've seen those spreads widen out significantly. They're now around 120 basis points.
120 basis points. For listeners tracking the credit cycle, what does that number signal about how lenders see risk today?
It's a key measure of fear, really. That 120 basis points, it's up sharply from the super tight levels we saw just a month ago. Late October, they were down around 75, 77 basis points then.
Wow, that's a big jump.
It is. In practical terms, it means credit markets are demanding almost 40% more compensation for taking on risk than they were just a few weeks back. This widening really suggests that, banks, sophisticated lenders, they're actively repricing risk. They're anticipating fundamentals getting worse, maybe bracing for economic pain that's actually worse than what the main stock indexes are showing right now.
That's a serious divergence to watch. Now, quickly, let's touch on digital assets, often seen as a kind of litmus test for global risk appetite. Bitcoin actually fell today, even as stocks tried to rally late.
It did, yeah. Bitcoin declined to $101,553. So that confirms the divergence from the S&P's late-day bounce back. The crypto space, it definitely seems to still be in a distribution phase, and that's fueled by those continuous outflows we're seeing from the Bitcoin ETFs, another $470 million in net outflows just this week.
Are there key technical levels analysts are watching closely in crypto right now?
The big one being cited over and over is $98,000. Analysts have flagged that as the critical bull market invalidation level. So if the selling pressure keeps up, we're only about, 3% away from a potentially major technical breakdown in Bitcoin? That would be a pretty significant shift in market psychology.
Okay, so bringing this all together, it really feels like the entire market outlook and therefore maybe how you're thinking about positioning, it all hinges on resolving this government shutdown. The stakes seem huge, especially with the CBO estimating it could shave 1-2 percentage points off GDP.
The immediate economic hit is undeniable. The Congressional Budget Office, the CBO, they're warning that while maybe some damage could be undone quickly once things reopen, the bigger risk is that this political paralysis just drags on long enough to actually break those critical technical support levels we've been talking about before they find a deal.
So based on everything we've covered, the weak internals, the data blackout, the stress across different assets, what specific technical levels should listeners maybe keep an eye on next week?
For the S&P 500, we really need to hold the intermediate support zones around 6,700 and probably more critically 6,650. If this gridlock continues, those levels look pretty vulnerable to a serious break. And again, keep that $98,000 level for Bitcoin in mind as a major psychological floor.
If you had to sketch out a sort of base case scenario for people, given this mess of political gridlock and economic blindness, what should they maybe brace for?
Well, our base case, which we'd put at maybe a 50% probability right now,
Okay.
assumes this shutdown just drags on into mid-December.
Okay.
And in that kind of environment, markets probably stay defensive. They likely trade mostly sideways, maybe in a range between, say, 6,600 and 6,850 on the S&P 500. And that narrow leadership thing just persists.
Sounds like high frustration, but maybe not total collapse. What's the biggest risk that could really knock that sideways scenario off track?
I think the single biggest risk is what we could call the consumer spending cliff. We talked about that sentiment index plunging to near record lows, 50.3. The real danger is that this extreme fear and uncertainty translates directly into just dramatically disappointing holiday spending.
Ah, right. The follow through.
Exactly. If consumers really pull back hard, then the Q4 GDP figures, whenever we actually get them, could sharply disappoint. That would instantly force the market to price in a much harder recession scenario.
That's definitely a provocative thought to end on, whether that rock bottom consumer fear is about to become a harsh reality for holiday retailers. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe and we'll see you at the next close.